Hello everyone, welcome to this session. In this session, we will discuss how bank panics led to the need for deposit insurance and how government across the globe responded to that, and then what are the further likely effects of deposit insurance, that is a government safety net, on the health of or the working of financial system. So, one of the response was the Federal Deposit Insurance Corporation was set up in the US, that was in 1934. This was as a response to the bank failure that happened in the US and other countries. So, you know that the 1929 Great Depression that started in the US and spread to other countries became a global recession. The global recession of 1929, one of the characteristics of this global recession was the bank failure. So, several banks failed. That was the one of the starting point of the global Great Depression. There was several banks failed during this period. So, this is called bank failure, and you know that if there is no government policy intervention or there is no government safety net, this bank panics and contagion effect, it actually happened in the US and other developed countries, and the bank failure, and it actually led to the collapse of the financial system, and subsequently it led to the economic depression in the developed world. So, as a response, Federal Deposit Insurance Corporation was set up in 1934. So, what they do, they insure the deposit of the customers, the depositors. That means if a bank failure, no issue, that actually the Federal Deposit Insurance Corporation will be refunding your deposit. That is the one of overall putting the function of the Federal Deposit Insurance Corporation in one sentence, we can say that if the bank fails, you will be getting back your deposit through FDIC. And obviously, in order to get the coverage, a small premium will be collected from the deposit, and that money will be used in order to make the payoff. So, there are two primary methods have been used to handle a failed bank. One is called the payoff method, and in the case of the payoff method, what the FDIC would do, the FDIC allows the bank to fail and pays off depositors up to the insurance limit. That is one method. And second method is called purchase and assumptions method. And actually typically these are actually more costly for FDIC. So, theoretically, or we can say that what the FDIC is supposed to do, that means when the bank fails, then pays off the depositors up to the insurance limit. That is the conventional function of FDIC. But actually, you know that by going through the importance of banking system, that means not letting a bank to fail, that is more important, right? If one bank fails and because of contagion effect other banks also fail, and practical sense we know that is not the best strategy. The first one is not the best strategy. It actually better to avoid the bank failure, so that if there is FDIC is there, if the FDIC is there, that is Federal Deposit Insurance Corporation is there, if all the depositors are assured that if the bank fail, immediately the Federal Deposit Insurance Corporation will be paying back my deposit, then because of that you can say that the bank panic this will be reduced, right? Even if one bank fails, people won't be running to the bank because they are now covered with government safety net, that means the deposit insurance, right? So, then this one this promise is already there, that the payoff promise. Because of that, one can expect that the bank panic, the magnitude of the bank panic will be reduced and the contagion effect will be reduced. And what if a bank is in trouble? So, normally banks, the FDIC practically they use the second method, that is purchase and assumption methods. So, if suppose if one bank is about to fail, then the FDIC reorganizes the bank typically by finding a willing merger partner who takes over all the fails bank's liabilities so that no depositor or other credit loses a penny. And however, this is typically more costly for FDIC. You know why? Because in order to ensure that some other banks acquire this failed bank, then actually FDIC has to often sweetens the pot for the merger partner by providing it with subsidized loan or by buying some of the failed banks' weaker loans. And because of that, is typically more costly in real and monetary terms for the FDIC than the payoff method. However, you know that more practical sense, actually the second method is most preferred method because it is better not to allow a bank to completely fail, and instead when the FDICs understand that one bank is almost about to fail, that means its net worth has become very weak, then it encourage the purchase and assumption method. In India, we had Deposit Insurance and Credit Guarantee Corporation. I would suggest you visit the website to get all the relevant information, what are the functions of Deposit Insurance and Credit Guarantee Corporations. Then about this institution, this credit deposit insurance scheme in India, it was set up, the act was passed in 1961 and came into force on January 1st 1962. So this was actually prompted by the bank failure, that the Lakshmi Bank and Palai Central Bank in 1960, and throughout in 1960 throughout India many banks have been facing banking crisis. Then out of these, 2 banks already failed. Then government responded with the Deposit Insurance Act in 1961, and then finally the scheme came into effect on 1962. In 1978, Deposit Insurance and Credit Guarantee Corporation was set up under RBI. So what DICGC do? DICGC insures all banks' deposits such as savings, fixed, current and recurring deposit up to the limit of this much 5 lakhs of each deposits in a banks. So banks pay premium to the deposit insurance and credit guarantee corporations. So actually when we deposit our money in the bank, actually we are not aware that a premium has been paid, because the banks will be paying the premium from our fund. That means it will be already included or deducted from our interest income that the bank will be giving to us. This is again I would suggest you visit Reserve Bank of India website to get the history of deposit insurance in India, how the scheme evolved and what are the activities, how it intervene in over time in the market in order to minimize or in order to reduce the bank failure. This is what we have seen, that one kind of government safety net what we have discussed till now was the response of government in the form of deposit insurance scheme, right. In the US we have seen, in the India and in most countries they are having deposit insurance scheme. Then another kind of intervention by government is lender, to act as lender of the last resort. Suppose even without deposit insurance, government will be giving other support. In addition to deposit insurance, government will be giving additional support to the troubled institutions and also by the government. So this not only one by central bank help the troubled institution, and also the government also help the troubled institution. So simply deposit insurance is not the only form of government safety net. In other countries, governments have often stood ready to provide support to domestic banks facing runs even in the absence of explicit deposit insurance. Furthermore, banks are not the only financial intermediaries that can pose a systemic threat to the financial system. So when financial institutions are very large or highly interconnected with other financial institutions or markets, their failure has the potential to bring down the entire financial system. So one way in which governments provide support is through lending from the central bank to the troubled institution, that is one way. So, this form of support is often referred to as the lender of last resort. So, what would happen that when the government is there or the central bank and government is there to support the failed bank, what we are going to see that maybe because of deposit insurance and the government is acting or the central bank is acting as the lender of the last resort, we are going to see that it is going to have some adverse impact, negative impact in the financial system. So, there are some drawbacks of this government safety net. Let us discuss this one by one. So, one of the drawback of government safety net is it will further encourage the moral hazard problem, and it will also encourage the problem of adverse selection. So, we have seen that because of asymmetric information, the moral hazard and adverse selection issues come up, and because of that actually the government intervention is required to minimize information asymmetry, and also for example to reduce for example the bank panic, government intervention is required in the form of government safety net, that is deposit insurance. Plus we also seen that governments steadily stand for the financial institution in the form of lender of the last resort. It is actually all came up to reduce moral hazard and adverse selection issues, but what we are going to see that it also aggravates. Is minimized. At the same time there are some other channels mechanism through which we can see that the government safety net, which is supposed to be a blessing but is going to be a curse and is going to adversely affect the economy, the working of the financial market. One is the moral hazard issues. So, the most serious drawback of government safety net stems from moral hazard, that the incentive of one party in a transaction to engage in activities are detrimental to the other party. So, because of the existence of deposit insurance, what is going to happen? Because here with a safety net, depositors know that they will not suffer losses if a bank fails. They do not impose the discipline of the marketplace on banks by withdrawing deposit when they suspect that the bank is taking on too much risk. So, importantly point is that because of the government safety net, since all our deposits are insured by government, that is the deposit insurance corporations, depositors began to take everything granted. They do not impose any discipline in marketplace. That means if they see that one bank is keep on investing in risky assets or they are making risky investment, then the people think that the depositors still don't take it seriously, because they think that doesn't matter, I will be getting back my money because government will be paying it back anyway. So, that is one. On the depositor side, they won't impose any discipline. So, similarly we can also, the depositors, not only individual investors, depositors, even institutional depositors, those who have the capacity to do the monitoring, they also won't do the monitoring here, because they are also assured that government will be paying back their deposits, or right. So, similarly financial institutions have an incentive to take on greater risk. Why? Because you can see that banks with a government safety net have an incentive to take on a greater risk than they otherwise would, because since the government will be the deposit insurance corporation will be paying back the depositors money. So, this actually make incentivize, it will aggravate the moral hazard problem among the banker itself. Banker, they themselves find that is better to, it does not matter, financial institution with a government safety net have an incentive to take on greater risk than they otherwise would, because taxpayers will foot the bill if the bank subsequently goes belly up. So, here you can see that if anything goes wrong, finally this is that the heads I win, tails the taxpayer loss, right. This is the bet here. Actually if they make a risky investment and if they lose, does not matter, finally the taxpayers are going to compensate, they are going to make the final payment to the depositors. Then the second problem, we can see that it also aggravate the adverse selection problems. You know how adverse selection problem, we have already seen that is an ex ante problem. That means the risk lovers will be liking, risk lovers means they will be making risky investments. So as a result of government safety net, risk lovers, who are the risk lovers, they find that banking industry is attractive. So they will think that since they will make investment, they would prefer, now risk lovers, they will be preferring the banking business, because the risk loving entrepreneurs might find the financial industry, particularly banking system, a particularly attractive one. That means they know they will be able to engage in highly risky activities. Even worse, because protected depositors and creditors have so little reason to monitor the financial institutions activities. That means now the depositors and creditors, they have little reason to monitor financial institutions, and as a result you can see that there is going to be more and more adverse selection. That means without government intervention, outright crooks might also finance an attractive industry for their activities, because it's easy for them to get away with fraud and embezzlement. So that means overall, because of the government safety net in the form of Deposit Insurance Corporation, we can see that it will be encouraging, that means it will be in one way or directly or indirectly promoting or aggravating the adverse selection problem as well. So to summarize this one, we can see that it will be aggravating the moral hazard problem and adverse selection problem as well. Not only this, we can also see that it will further make the too big to fail as a serious issue. So the moral hazard created by a government safety net and the desire to prevent financial institution failures have presented the financial regulations with a particular issue, that is called too big to fail problem, in which regulators are reluctant to close down large financial institutions and impose losses on institutions, depositors and creditors, because doing so might precipitate the financial crisis. So that means government won't allow large financial institution to fail. That means government provides guarantees of repayment to large uninsured creditors of the largest financial institution, even when they are not entitled to this guarantee. And this term too big to fail, it was popularized by US congressman in 1984. The too big to fail is a concept used for banks or financial institutions that are so big and interconnected that if they fail, the economy is at the risk of substantial damage. That means it would eventually lead to a financial crisis, and financial crisis would further lead to economic crisis, that means economic recession. So normally in general there is a perception among the general public and financial institution that large financial institution, even because of their own activity, if they engage in lots of adverse selection and moral hazard behavior, even if so, government won't allow them to fail, because if they fail, that means the entire economy and their financial system is going to collapse, and that means it is going to lead to economic recession. That is nothing but increase in unemployment, the decline in GDP, decline in government revenue, that the government tax, all you know that actually finally is going to making the life miserable, right. So because of that, you know that the government won't allow this one, and this term gained more popularity during the 2007-8 crisis clash. During this time it became the concept become even more and more familiar. So before discussing more about this one, you just think what if a large bank in India, suppose SBI fails. So we can just see that if SBI fails, you know that is one of the largest commercial bank in India with several branches and accepting deposit from millions of households and institutional investors, and lending money to the different sectors of the economy, and also investing in government bonds. If SBI fails, obviously you know that it is going to make adverse impact on the entire financial system and subsequently on in the economy as well. So what SBI in this case, we can see that from SBI perspective, maybe we can see that they may be making lots of that risky investment. Even if this fail, what they will be thinking that even the government won't allow, even if their net worth become negative. Suppose the net worth because net worth become decline and become negative, even then they will think that since they are too big, they are actually too big to fail, government won't allow them to fail. And because this actually what happened that this too big to fail policy increases the moral hazard incentives for banking institutions, and not only for banking institution and also for non-banking financial institutions that are extended a government safety net. So, knowing that the financial institution will be bailed out, creditors have little incentive to monitor institutions and pull their money out when the institution is taking excessive risk. So, as a result, what we can see that large or interconnected financial institutions are more likely to engage in highly risky activities, making a financial crisis more likely. So, at the end of the 2007-8 financial crisis, we know that in the Congress there was lots of discussion about the bailout package. Initially it was declined, and later on you know that a bailout package was passed. Actually we can see that the financial crisis of 2007-8 was man-made crisis, mainly because the financial institution, especially greedy investors, greedy financial institutions, and they actually created 2007-8 crisis as per several analysis and reports. Finally, who was to pay? The bailout package, finally it was passed, and the billions of dollars were spent for the bailing out of the financial sector in 2007-8. Finally, it was the taxpayers' money, let us call it Main Street, and Wall Street means the financial sector. And finally, because of the greed of Wall Street, the 2007-8 crisis happened. Finally, all the loss, it has been compensated by the Main Street, that means the general public, that is the taxpayers' money. And why it happened? Because at the end you know that we cannot allow the big financial institution to fail. We need them, because if they fail, the entire financial system will collapse. That means then the financial system is not there, which we discussed in the beginning of the course. That means the financial market ensure the smooth flow of fund from those who save and to the sector where it can be make more efficient use of capital. And without financial system, this movement won't happen, that the smooth flow of fund from one sector to other sector won't happen, and the economic activity, that the investment will productive activities will come down, that the economic activities will come down, and economy will be in a economic recession. Right, an economic recession will take place, and because of all that, and you know that we cannot make the financial market, that the financial system to collapse. So that means at the end you know that it will be the taxpayers' money will be used to bail out the big financial institutions. And you can see that the bank failure, it also happened. Maybe one of the reason is that the 1980s to this period bank failure happened, and several analysis has been saying that the bank failure, because here during this period you know that because of this the FDIC was set up, right, because of as a response to bank failure. And further analysis maybe, and then after many years, several years, because of this there was a little bank failure in the US. But in 1980s, after 1982 to 1990s, 92, you can see that several many banks failed, number of banks failed, you can see that is many banks failed. And one of the several analyses suggests that the reason for the bank failure in the 1980s to 1990s is mainly because is one of the consequence of government safety net, that the deposit insurance corporation plus government standing, or that government standing or central bank standing as the lender of the last resort, that also contributed to the bank failure in the 1980s. And again 2007-8, again you can see that several banks failed, and here also we have seen that the too big to fail problem we have seen here, that, and you know that again it may be, many analysis suggest that it also because of one of the adverse effect, the drawbacks of government safety net. So mainly the bank failures in the 1980s was mainly, it was considered as mainly because of the existence of government safety net. In addition, the financial innovations also produce new instruments that widen the scope of risk taking, and several banks they issued junk bonds during as part of their financial innovations. And issue of junk bonds, they thought that they issued this one, however again it on the backdrop, it was a perception that if something goes wrong, if their investment goes wrong, the government will be bailing them out. In addition, we can see that financial consolidation and the government safety net also contributed to the bank failure. Let us conclude this session here, and let us continue this discussion in the next session. Thank you.